what's going on? I know it's been a little of a break, but we've been busy with work, some trips, some unforeseen events. The CFA is coming up in June. Our level 2, we'll be writing that. But today we have another topic for you. We're going to be talking about dollar cost averaging. But before we get into that, Julian has a very, very special announcement and a big milestone for Personal Finance Boss.
Thank you, Ali. The big announcement is our course is finally live. And for those who follow us on Facebook, you would have seen that we posted this, I think, 2 weeks ago.
Mm-hmm.
But we haven't had the chance to make a podcast in these last 2 or 3 weeks. So now is the first time that you guys are aware of it. Our course is live. We will post the link in the description.
Mm-hmm.
It is also on Facebook. We've hosted it on Udemy in terms of simplicity for now. We may be thinking of creating our own platform, but we'll see what's out there and what's feasible and what fits in our timetable.
Mm-hmm.
So essentially what this course is about is it's intro to investing pretty much. So we talk about GICs, bonds, stocks, mutual funds, and ETFs. We talk about the pros and cons, and we show you guys exactly how to buy these different investments. And with this course, you'll be well off to start your personal finance journey. Obviously, it's an intro level course, so it's for those who really don't have any experience purchasing or who are having a hard time convincing themselves, like, okay, well, I don't know how this works. Mm-hmm. What are the risks? Like, what are the money? So we sort of answer all these questions for you guys.
And we show you live examples using our brokerage. So you'll see exactly how the trade screen is working, how to go about reading a prospectus, reading a mutual fund, the holdings, the MERs, everything, all about it. And for those of you that are super eager and can't wait till we post it, the course name is the Personal Finance Toolkit, and you can search that on Udemy, and you'll be sure to find it by the PFB creators.
Yes, thank you, Ali. Mm-hmm. So moving on to our topic, dollar cost averaging. Mm-hmm. Now, we sort of touched on this when we talked about market timing. Mm-hmm. So just as a reiteration, what is market timing?
So market timing is the process of picking the most opportune moment to invest in the market.
So essentially buy low, sell high, right? But perfectly time it.
But perfectly time it, because everyone thinks they have a sixth sense in terms of, oh, I know when it's going to go up. I heard from Joe that this economic indicator is flashing, which means the market's going to go up. So I'm going to buy today, pocket that ride up, and then sell. Unfortunately, none of us have a sixth sense or a magic 8 ball. Otherwise, we wouldn't be here talking to you, and you wouldn't be listening to us.
Well, some people do, but we don't.
Yeah, but I don't know. There was actually, for like a little side note, there's this famous book called A Random Walk Down Wall Street. And in it, they talk about this experiment about how if you were to take the index, for example, it would most likely beat even a portfolio. Like if you took a portfolio, the guy said, take a portfolio and have a monkey shoot darts at the Wall Street Journal, and it'll land on different ticker symbols. Okay. Pick that, and most likely that will have a similar return over a long-term period as compared to the index.
I think 5% of fund managers can outperform the benchmark over a time frame of like 5 or 10 years.
Yes, including fees.
Yeah,
including the fees.
Net.
Including the fees.
Yeah. So that just gives you perspective as to, okay, well, is market timing really a viable strategy? Mm-hmm. So proceed.
Mm-hmm. Yeah, so market timing, picking the most opportune moment to kind of get in. And the way we kind of go around that is with dollar cost averaging. So what dollar cost averaging is it's a completely automated process in which you're going to buy securities, mutual funds, ETFs, even stocks if you want, but the commission is going to eat you alive on those unless you're trading like, I don't know, let's say $1,000 every month, for example. Yeah. But the dollar cost averaging process is a fully automated process. Basically, you set it. I'm going to buy the index ETF for the S&P 500, and I'm going to buy an index ETF for the NASDAQ every second Thursday, and I'm going to buy $50 of it. Yeah. And basically this way, over the course of the year, over the ups and downs, over the different earnings announcements, you're going to pick up on different price points at different times. So maybe one day you're going to pick it up at $5 a unit. Next day it's going to be $5.40, $5.10, $4.50, and over the course of the year, it's going to average out in terms of price. So you're going to pick up on the dips, you're going to pick up on the highs, you're going to pick up when it's just flatline. But the important thing is you're taking prices from different points, averaging down, averaging up, averaging out your cost.
And there's a few benefits to this. The first one is if you're expecting a recession, if you're expecting a bull market, right? Like, first off, you don't know exactly when, you don't know what, and you don't know for how long. So by saying, I'm just going to buy, stocks over the next year, over the next 2 years, if you have like 10,000 to invest and that's all you want to put in, like, do you buy it all at once? Do you buy it over 5 years, 2 years, a month? So by using dollar cost averaging, you can say, okay, I want to average my way in for 6 months, and you sort of spread out this initiation. And if ever, you buy all at once and then there's a small dip, well, you lose a lot of money. But if you're buying every, week, every 2 weeks, then you get to sort of spread out that risk. But at the same time, you lose on market uptakes.
Yeah. And go ahead. Well, just as an interesting note of talking about market timing, we know, like, right now, a lot of people are saying, oh, some economic indicators are flashing. There's a slowdown. There's a recession. According to like a lot of stock graphs, when these economic indicators hit, the time to the recession is actually about 18 to 21 months. So we're looking at a period of 2 years of still very high growth in the market, or positive growth compared to when the recession hits.
I read that some of them were 8 to 9 months.
It depends, but it's not. It's the important thing is it's not instant.
The inversion of the yield curve.
Yes.
How long of
that is the indicator, and that leads between 18 and 21 months.
Okay.
That the market will actually go down, and obviously that can change. That's not a fact, and it could be longer than 21 months. It could be 5 years. It could be 10 years. It could never happen. Yeah. And a lot of people are saying, like you said, I have a big chunk of money. Why would I put it in now when it goes down? Just to lose it right away, and I can wait until it goes down, buy it, and then goes up. But what if it never goes down?
Yeah.
And there's a great saying by Warren Buffett. He always talks about set your money in an index fund, lock it away for 50 years, close your eyes, don't worry about it, and then in 50 years you'll thank me. Yeah. Is the way it goes. And there's a great thing with market timing. Look, if a stock is going to go from $1 to 100 over the course of 20 years, does it really matter if your entry point was $1 or $1.50? Yeah. At the end of the day, it doesn't really matter. The point is you got in, you got out at a good point, and you made a great return. Yeah. You never want to be someone that's sitting on the sideline saying, I was going to do it at $1, and then it went to $2, and then I just said I'm not going to do it anymore, and then that stock takes off. Yeah. No one wants to be in that boat. So dollar cost averaging allows you to kind of move around market timing and go at it.
Yeah. But now for the second point why this strategy is very powerful, I think, is, it sort of takes away all of the decision making and all your time looking at graphs, looking at reading analyst reports. Oh, it should be next week. Like you said, it doesn't really make a difference. If it goes up or down 1%, like, big deal. It doesn't really change much if you're in it for the long term. If you're day trading, swing trading, that's a whole other thing. It's all about timing. But we're not talking about this because statistically speaking, more people lose at that than win.
Yes.
So we're really talking about this from an long-term investment perspective. The third thing is if you actually run the numbers on it, it makes a lot of sense. So for a simple or maybe not so simple example over voice, if you buy $100 worth of stock at $10, and then X amount of time later you buy $100 worth of stock at $7.50, you buy $100 worth of stock at $5, so you buy it at 10, 7.5, and 5, all $100, and then the stock goes back up to $7.50, which is the middle ground between the high and the low. Yeah. Did you make money, lose money, or stay the same?
You stayed the same.
You did not. Because you were able to pick up more shares.
Oh yeah, I picked up more shares at the $5.
Exactly,
and I picked up more shares at the $5. Yeah,
and that's the mathematical rationale behind dollar cost averaging and why it's so powerful and why people don't realize it, Ali. That
I fell for the trick as a learning purpose.
Exactly. Oh no, this was a pre-rehearsed. So Ali obviously knew this before, but this is what I would tell people when I was explaining this to them and have them realize that. It sort of mitigates risk on the way down. It's very important that you buy the same amount that you did when it was higher. That way you can sort of break even when it goes back to the middle ground between the high and the low. So that's another reason why this is a pretty powerful strategy. Obviously, if you only bought at $5, then you go up to 750, you make the max profit.
Mm-hmm.
But had you bought only at 10 and then it goes down to 5, you freak out and you sell, or you hold till 750, you still lose much more money than if you dollar cost average your way in.
And that's a time also if you're dollar cost averaging and you see that dip go down, some people say, I'm going to take a bit more at this time and pump it in, but still continue with my overall strategy, which can be a great thing. That I wouldn't really say is market timing, because you're putting in the money and still sticking with the long-term strategy.
Well, technically, it's just...
It is, and it is...
It's like 10% timing, 90% dollar cost averaging, right? Because you can also say, well, fine, when the stock goes up, I don't buy. But every day the stock goes down, I buy. That's
the thing. There's a big thing with dollar cost averaging and saying that I'm only going to dollar cost average when there's green signs flashing or when it's flat. Exactly. And when the market tanks, I'm just going to stop because I don't want to lose money on the way down. But on the way down, like you just said in your example, that's where we're going to pick up more units, and when that stock takes up the positive trend again, that's where we're going to be making a higher return and
we should
more money.
Do a podcast on hedging as a side note now that you mentioned that, but yeah, exactly, and it goes against human psychology to buy on the way down. So it's very hard to say, okay, I'm up $1,200 on this position every day, I'm losing $50. Why am I putting money in, and why don't I sell?
It is against psychology, but if you think of value investing, that's what value investing is. It's looking at, okay, this is the market out there.
Well, value investing is a bit different. It's buying low PE stocks.
It's buying undervalued stocks as well. And most likely, if the PE is going to be low, the price compared to the peers is going to be lower as well.
Yes, but in this case, I'm saying if you've been buying a position in the S&P 500 for the past 6 months, you've made $1,200, and then the market decides to correct.
Yes.
You then see your profits wither away. You're like, well, I could just sell.
Yeah, they wither away. Yeah,
I can sell and take my gain and re-enter.
But the thing
when
is,
it's cheaper.
The thing is, the problem with that is a lot of people are good at, I'm going to sell.
Yeah,
I'm going to take my profits of 10%. I've done good. I've made 10%.
Yeah,
can set it away, take it out. They never re-enter.
Yeah,
because they're always waiting for that ground to hit at the bottom, and then the soon it takes up. Oh no, it's going to go back down. Don't worry. Yeah. And then it takes off.
And then they end up re-entering
at the high point, and it drops down.
At a price higher than what they sold at.
Yeah.
So they ended up losing even more money, plus commission, by doing this double trade.
Yeah.
Sometimes, like I do that sometimes. Sometimes it works. Sometimes it doesn't.
How many times does it work compared to?
I don't know, but the main thing is you don't follow the stock market every day.
Exactly.
If you're working, you're busy. You sell it, you forget.
Yeah.
And then you're looking at the stock, you forgot at what you sold it, you don't remember, and you don't check because you're lazy.
Yeah.
And then you realize, oh well, this went up to way above where I sold it, so I guess I messed up.
And like dollar cost averaging, it really like fits in really well, I think, with automatic savings plans where you can just set.
Yeah, if you're buying
ETFs and mutual funds, ETFs because usually there's no commission involved with the buying. But if you're buying stocks, then dollar cost averaging becomes a little bit more trickier because
you can average, like dollar cost averaging just means averaging in, meaning you don't buy. If you have 10,000 to invest, you can buy it in 3 transactions instead of 1. Yeah. So you buy 33 over a period of a month, and that can technically fall into dollar cost averaging, just as spending $50 a week for your life is also dollar cost averaging as well. So,
but the thing is, in a month, the chances of picking up those ups and downs is less pronounced in the month than a longer period.
For sure,
of time.
But both of those strategies
they do qualify as DCA.
Yeah. So DCA. I'm sorry.
We use the fancy terminology now. Yes. Because our viewers are so familiar with it.
No, they're becoming more and more sophisticated.
Exactly. Yeah. So we got to use that sophisticated lingo. So then when they talk to their friends, they can put out all these terms and.
I never heard about DCA. I think Al is just mad because he didn't get the example right.
Oh yeah, I'm. That was a cheap shot. It's been a long day at work. But I think, and I wanted to point out some of like the people out there that kind of try to dissuade you from dollar cost averaging.
Okay.
Which would be, again, our best friends at the banks. And we notice, because that's honestly where...
I guess that's important.
At the level with the financial planner, it's not going to be as pronounced because you're going... The the mindset with the financial planner and the mindset with the advisor is a bit different because the way they're compensated is
Well,
is
not
different.
even that. Is the advisor is probably going to be in this position for a much shorter time
Yes.
than the planner.
Of course.
So if the advisor, if you're going to invest 20K over 2 years, well, the advisor is only going to be in his position for 6 months, so he's going to miss out on
That's
the extra.
considered long, also, by the way, 6 months.
No, exactly. It is for sure, actually. And he's going to miss out, so he's going to push you to invest all your money right away
Yeah.
because he's compensated based on the
What
volume
volume
that
he
you
brings in,
invest.
exactly.
So you have to be careful if you're doing this with a bank. They do make commission selling an automatic saving plan,
But they make more as if it's going to be a one-shot
for sure.
type of thing.
sure.
Especially if they're getting a big sum, they're making a big sum like 20 grand. For
Yeah.
them, it's a big sum. For the planner, it's not as
Yeah, the planner,
substantial.
the way it works is they work with the client long-term plan, and usually the people that are there have worked very hard and are very qualified, and they're paid, good money. So it's not.
And their mandate is we got to take care of our clients.
Yeah.
And if the client says, well, why didn't you suggest that we average in our position rather than taking 500,000 and plowing it in one shot, he's going to have to answer for that. Whereby the advisor will be halfway to China doing another role.
Yeah, and usually they're more sophisticated, the people that use financial planners. So he can't, what's the expression?
Take advantage.
Take advantage, run a quick one. What is it?
Get away
Anyway,
with
pass
run by you?
pass something under your nose without you noticing it
Yeah.
and sort of taking advantage of you because you don't know exactly what's going on. So there's also that, but it's more, yes, when you do walk into a bank, that was a good point. Be wary of how they get compensated because they may not be giving you the best advice, which is we keep talking about this all the time. But that was a good point.
And actually, you have the right as a client to ask them how they're being compensated. You can ask them that question, and you shouldn't be ashamed or nervous of asking because it's an important thing to know how they're gonna benefit off your hard-earned money that you're putting in. So it's just something to be careful about. Mind you, you have to be careful with the financial planner as well because not all of them are going to be as sophisticated as some of them.
Well, not all of them are going to have your best interests.
Exactly. So you just always, we always go back to just always do your research but this is just another option that you can use. It's another tool to kind of average in your position. And especially maybe if it's a first time for investing and you said I have these savings over the summer, I save $5,000, instead of taking the whole bit and just saying here let's try it in the market, this can be a good way to kind of average in, see how it's working out, and then continue on that, and even start with small sums and go. With mutual funds and ETFs, it can be very easy and cost efficient to dollar cost average. With stocks, because there's a commission, if you're doing smaller sums, you may end up paying a lot of it upfront in commission before making that money back.
Meaning, if you're going to put $25 or $50 a week away, paying $5 or $10 every time, it's like, okay,
exactly. I wouldn't really recommend that. It can be fine if you want to get in, but for that, I would say try to up it a little bit for individual stocks. If you're doing ETFs and mutual funds, you can do $10, $15, $20, $25.
And the reason we say that is because on our brokerage platform, we don't pay a commission purchasing ETFs.
Yes.
So not all brokerage platforms will have this, but Questrade does.
And I'm also saying that because when I started investing, I used to make a lot of trades, and they really rack up. I think 1 year, was it 1 year? I had 100 trades.
$1,000 worth of commission.
I had 100 trades, I think, which was $5 of commission. $500 of commission.
I think it was more.
More?
Oh, yeah.
Oh, you're making me feel really bad now.
I think we realized we spent it was $1,000 or $1,200 on commission.
In 1 year?
I think so. I'm not sure.
Oh yeah, because you did some options as well.
But it was really bad. It was really embarrassing.
It was a lot of commission. It was fun. But no, it was because that's how you learned. You learned
if
this
you
is a
spent
long-term
$1,200 on commission and you made $20,000 in profit, that's okay.
Yeah, of course.
But that's
if you
not
didn't,
usually the case.
Yeah, it's never the case except if you're very, very, very experienced and
lucky.
you need a little luck.
Yeah.
But all to say, dollar cost averaging, great way, kind of get your feet wet with investing. Great way to kind of move around market timing.
And mitigate your risk.
Mitigate
the risk, pretty much. That's why you would do it. And I think we pretty much touched everything. Just like Ali said, you can't do this with everything. like bonds and stocks, it's challenging to do this unless you do larger sums every 6 months, which would still count. But yeah, if you don't pay for it, then that's always good.
Anyway, again, if you want to check out our course on Udemy, the Personal Finance Toolkit, we will be sharing a link on Facebook and Instagram. And as always, you can reach us on our Facebook page at Personal Finance Boss, or on our Instagram page at the same handle, or at personalfinanceboss at gmail.com.
Yeah, we're on YouTube.
Thanks for tuning in, guys, and we'll see you in the next one.